Hi, we're here today to talk about tax write-offs and how they work. In general, a tax write-off is something that you can claim as an expense, and it reduces your adjusted gross income, and therefore your tax rate is based on a lower amount. For instance, you may have received $50,000 in salary, and if you have a write-off of $2,000, that takes your taxable income down to $48,000. And when you go to the tax tables, you can see that obviously $48,000 requires you pay less tax than $50,000. So the write-offs are a helpful, obviously helpful financial tool. Now, there's a difference between write-offs and credits. Credits are actually applied to the amount of tax that you owe. If you're in the 25% tax bracket and you have a $100 tax write-off, that would reduce your adjusted gross income by $100, which in the 25% bracket would equate to saving you $25 in taxes. Whereas a $100 tax credit would come right off the bottom if the taxes that you owe were, say, $1,500. That $100 would come right off the $1,500. So obviously, anytime you can take a tax credit, it's far more beneficial than a tax write-off. But typically, most people have more write-offs than they do credits.